Hi, this is Randy Finney with Right Side of the Chart, and this is a early session update for Monday, February 9th, 2026. It's 10:47 Eastern Times. I'm starting the video. Here's what we're going to cover in this order. Quick housekeeping note. I'm going to be leaving town today, shooting over to the other coast for just through tomorrow. So I'll be working today, cutting out a little bit early to leave town. Back tomorrow after the market closes. So updates, that's pretty much the only day I'll be out this week. So I'll get back to any comments, questions, replies once I get back in town. So I'll catch up on Wednesday. All right, we're going to do this in this order. If you want to skip ahead on anything, I want to cover the equity markets first. A few things I want to look at there. Maybe a couple miscellaneous sectors and trade ideas. I want to hit on BIZD, just an update there. The software stocks, SSW, definitely want to update there. I want to look at the payroll companies, ADP and PAYX. Definitely want to do an update on Bitcoin and strategy. And then also want to definitely do an update on gold, silver, GDX. And that should be it. That should keep us pretty busy. I'll try to talk fast. I won't go into too much detail because a lot of this is just kind of a update to the extensive analysis I've been covering lately, especially on the equity market. So let me start out here with QQQ. We remain smack in the middle of the trading ranges. Just to recap, last week we punched down almost a perfect tag of that key 589 support. That's the bottom of the trading range I've been highlighting forever and a day. I'm sure at this point in time, others have to be talking about this. This is one of the most obvious and well-defined trading ranges in the equity markets in years, really. So, like I said, whichever way it breaks, other than a whipsaw, obviously, that's likely the way we're going to head. But my thoughts haven't changed. Any new high will still be a divergent high, and with the technical posture, the indicators in many key stocks and other things, I would suspect that breakout will fail if we even get there. As of now, here's what I can tell you definitively. Today, we're at the back to the midpoint of the range. That's resistance, roughly 614. The 50-day moving averages also comes in right there as well. Typically, when the NASDAQ 100 or the indexes are above their 50-day, that's the yellow line. Trend is bullish. When they're below, bearish. We were down there for a few days. That was an intraday spike only to recover back above. So far, all these have been just brief, either one day closes or just intraday moves back above, only to back below it, only to close back above it. So we're coming up on resistance. That's what I can tell you definitively. It's just kind of a mixed bag of a lot of things right now in the equity markets. But again, I'm going to go over those things. So that's it. There's not a whole lot more to add on that. We're coming off a divergent high on the 60-minute chart. But again, we're in this big trading range here. These are just micro levels we've traded off of last week. I give you a couple day trading ops, bounce trades. Both of those were successful. Quick 1%, reversals. If you look at it that way, cover shorts, go long. It's really a 2% round trip profit. You avoid giving that extra 1% back on, if you were short and you covered a short or go long, swing short, game the long. You book that 1% profit. You sidestep the 1% give back on the loss. Again, that's net 2% boost to your account. But that's it. So right now it's just noise. We're still within that trading range. And again, if you're tired of hearing that, I can't force the markets. I'm giving you the analysis and telling you that it will break sooner than later. And expectation remains to the downside. And I do believe that was the last hurrah off 589 right there. And the next time when we get even close to it, we'll probably punch down through it. Then you have the 200-day moving averages, which I suspect will be cut through on the initial drop once the trading range breaks. Because the trading range is so well defined, it's like I say, energy building like a coiled spring. Probably hit T2 and bounce. That's again kind of working scenario. We'll see and take it day by day. But again, if you're frustrated because you're a swing trader investor, well, welcome to the club. That's what the rest of the world's feeling. And if you're an active trader and you can game the little bounces here and there on the intraday charts, then you're making some money on the market. All right, that's it. Let's not beat a dead horse. We're in those trading ranges. The S&P 500 is still at the top of its multi-month trading range. It's had a couple of attempts to get through there. It keeps falling back down to the midpoint, and that's it. So we're also back testing this trend line here. Still favor a move down to and ultimately below. You have the 200 days also just below as well. But again, we get down there. It's the key October 10th lows. That's what I've been waiting to break for a long time for a more powerful sell signal. And guys, I do think it's coming. But I'm going to show you, things that can hold the market up and things that could, if those things go the other way, things that'll bring the market down. So let me get to that. Before we move away from the S&P, we'll take a quick look at the 60-minute chart. Remember, we're coming off these divergent highs. It's not as if each one hasn't worked. And the divergent lows, you look for the divergent lows, they give you the rallies. And so that's what it looks like here. And that's our most recent divergent high. And again, it's just one big divergence that's been building now for a while. That I didn't draw that line proper, but that really carries through on the daily chart. And even the weekly charts have the big divergence as well. So let's look at the smallies real quick. Small caps, these bounces, especially within the trading ranges, they're not random. That was we shorted IWM most recently right here. We went down a little, put in a marginal new and still divergent high. Went on down, took out the trend line, hit my first target, and we bounced. Then we hit my second target almost perfectly and bounced. And these were the resistance levels I gave you back when we hit T1, which would be my likely stopping points, and we're right there right now on IWM. So it's minor resistance, and it has the potential to cap this pullback. But again, this week is sloppy. I'm not going to be around, like I said, through part of the back half of today and all of tomorrow. So I'm just keeping it light, giving you guys what to watch this week. And let's see if the market can show us its hand. So that is it. When we look at the daily chart for the smallies, remember we're coming off this big divergent high here. I also gave you price swing targets on the daily time frame as well with that trade. And basically that was the first target hit when we bounced. And the 50-day moving average, you see that yellow line there, right there. So those are the levels that need to go in order to trigger the next sell signal. All right, let's move on to, let's talk about the financials. As I've been saying forever and a day, unless the financials crack, the stock market's going to likely hold up. And that was it. So we had this false breakout here to new highs, fell back below the 54.47 level. Bear flag there, took us down to this 53-ish support right there, which so far has held. And we're also currently back testing this trend line. So again, my preferred scenario, and I think most likely X scenario, I should say, is a break of that level. But unless it happens, you got to take out 53, and then the 200 days are just below. Remember, those are also very important moving averages for the financials as well as the broad market. Bullish when you're above it, and traders will buy pullbacks to it. And then when they break, as they did right here, you get a correction or a bear market or trend change. And that was even from that point below the 200s, there was another 10+% downside. And then again, you can go back longer in time and see. We haven't had anything close to a bear market or a real good old-fashioned correction since back in 2022, and that's when you lost them right there. And then traders kept shorting them until we took them back. We clearly took them back there. There was a little bit of a trading range. I always say don't put a lot of weighting on moving averages when you're in a trading range, because it's not unusual to just go through them a little bit. So they work best when you have a trending market, and then it's the initial breakdown above or below that triggers that sell signal. So not a lot of change in the financials. They just continue to also kind of grind around. They led the broad market up recently, and like the tech stocks, they're just kind of grinding around. So I wish I had anything new or different to report to you, but I don't. That's it. All right, semis are also a big sector, a subsector of the tech sector, and that's it. This is SOXX. Remember, we had this minor trend line break and back test right here. We hit the primary uptrend line right here. This is the one that needs to go. And you can see it also comes in perfectly, or did the other day when we hit it, with the 50-day moving average. Again, bullish when you're above the 50. They like to buy pullbacks to the 50, just like the 200s as well. Yeah, the 200s are very important there as well. So once we break the 50 and we break that trend line, the next stop in the semis most likely is going to be this 272 support and that those 200-day moving averages, which come in right there. The semis go down, the NASDAQ usually goes down right there with it. Still keeping a very close eye on BIZD. That's the Market Vectors BDC Income ETF, aka private credit. And that's it. So we're still below that 1352 key level. Remember, that was, we had a major sell signal triggered there. Fourth target hit there, reversed it, bounced it long, and most recently we cracked below there. So I just wanted to highlight we are back testing that level, and there is big positive divergence. But if we are in the early stages, especially in this sector, well, it wouldn't be so early. This one peaked back a while ago. But if it's in a bear market, as I often say, just like bull markets are, the road to a bull market is paved with negative divergences, meaning you get some divergent highs along the way, and they tend to get plowed through or just result in a minor correction, minor pullback. Same thing often happens in bear markets, where you'll get these divergent lows, and they either play out just as they start to look like they're playing out, they get sold into, or they don't play out at all. So, but it is worth noting, because if we can recover, if BIZD snaps back above here, really this trend line it needs to take out, it could rally. And it's most likely only going to do that if the stock market holds up. This is still a sector where I believe there are more likely more shoes to drop, and I'm watching it very closely. I'll also point out, I would be remiss not to, this major reaction low back here from 2022 when everything was dropping. That would be your next support level. And beyond that, when you look at it from a longer term perspective, here we can even toggle over to a weekly chart. You can see there's the, this is a weekly chart. So it's as far back as we can go. This one started trading back in around the end of 2012, early 2013. And it's just a very nice support level. This was COVID. COVID, as you know, was kind of, everything, the bottom fell out of everything, but then they came in with massive stimulus and everything snapped back. So it's still a very significant support level here. And that's really, traders are going to watch that previous reaction low. And if we go down, if we take that out, it's just going to be a bad sign, showing you there's problems with the credit markets. That's all. And like I said, we can, and I might even revisit it if things hold up this week and things start to firm up. Again, I'm going to show you some of those things. Maybe we'll throw this one on as a long trade idea. Divergence in itself isn't a buy signal, but if someone wanted to take a shot at it, it still pays a pretty healthy dividend. You could take a shot with a stop not too far, maybe below that 1297. I would do it on a daily closing basis, not an intraday, because they'll probably, if they get near there, they're going to, it's just what they do, the nefarious powers that be, take it down, run, blow the stops out, and then come back up. So that's why a daily close below 1297 or 13, call it 12, say 1295, would be help to minimize the chance of getting clipped out in the stop rate. All right. Before I get away from the equity markets, I just want to mention that custom Hindenburg indicator I've shared with you in the past. I won't explain it now because the video will go too long. You can loop back to some of the other videos. Look for the market tag with a dollar sign, I think I use, or a pound sign, and then the word breadth. That might be in there. When I covered this is a breadth indicator, and it's just my twist on the classic Hindenburg indicator that someone else came up with years, really decades ago. And it keeps firing right here. This is the criteria. This is a cluster. The only kind of, if I want to go be a purist with it, one of the criteria, or at least the original, was the NASDAQ needed to be traded, or it was the original Hindenburg's based on the NYSE, New York Composite. It had to be above, trading at or above where it was 50 days ago now again. So this one, the Nasdaq's a little bit below. 50 days, as you know, is about a month and a half. It close enough. And in fact, most of those it probably was. You have to go back here. Remember, we've been in a trading range, so usually you're going to not see so much sideways trading range. So I just wanted to kind of point that out there. But the number of new highs versus new lows, and everything else, all the other criteria have been checked. And there's a cluster. And again, the way this indicator works, it's not a one signal. It's the more you get within a short order, a cluster helps to affirm that signal. And it's a crash indicator is what it is. So watch this. And again, thing about it, you don't position on this. You can certainly, it's more of a heads up indicator. But the beginning part of this video and every video I do have given you the levels that I think, and I refer to lights out levels. You've got the bottom of the trading ranges in both SPY and QQQ that need to be taken out first, then the 200s, then the next price target levels. So again, and just keep that in mind that if that happens, this just adds evidence, just like with silver the other day. How many of you on the site that took the short that we had probably covered early on in the day on Friday when silver is crashing, but we had a lot more to go. And, I predicted on Thursday night, we probably, the likelihood for a crash was quite elevated, and we could see it as early as the next day, which was that Friday, or the following week. And so that happened, and then you might have left a lot on the table had you been short silver. So that's kind of the takeaway in how I use these indicators. Where I might normally start to cover a short on early target, or let's say the 200 days. Because of this, I might sit tight expecting that if the bottom of the trading ranges are taken out in SPY and QQQ, that we can just smash right on down through the 200s like they're a minor speed bump, if that. Okay, so other than the markets being in the trading range, I'm going to revisit this XSW. We did, let's see, what was that? Remember, these are suggested stops. I use them based, max stop will be calculated using a favorable RR, risk-reward ratio, to the final target. And so if you're targeting different targets or the early targets, you'd want a different stop. Okay, and this trade is still in play. And I still like it. And I like it especially as a hedge, an indirect hedge, to a short on the QQQ, on the NASDAQ 100, because I continue to believe, and I've been pretty persistent on this, that I think this is the downside. I think this will outperform the broad market. By outperform, it just means, the market can go down, this can go down with it, but if it drops less than the market, then that's outperformance, especially when I'm talking about the QQQ. So that red candle you see there, I've set these now to, if it's a hollow candle, that means intraday we drop only to close back above. So if you can see on the crosshairs, pop-up box to the left shows that we closed on February 5th. That was Thursday, that day of that red candle. We had to close at 148.25. So that was a well-placed stop. They didn't get us. I'm sorry, what did I just say? 148. Yeah, 148. Yeah, I'm right. 148.25. Stop was suggested stop 147.95. So we managed to avoid getting clipped out on that one. Let's see, when I zoom in, I just dragged these lines that they're not auto set to the level. That should be 147.95 would be about right there. Yeah, so very close, but still in play. Now look, as I mentioned and say often, fewer things in trading, from what I've seen over the years, are more bullish than a false breakdown or whipsaw. So this is the trend line that we bought it on right here. And you can see we had that some volatility in the week, a move down below. And right now, not by a lot, but we are back above it. But you really got to punch. Remember, there's also horizontal price former support, which then becomes resistance right here. So if we can go on up, either way, I'm just going to stick with these trade parameters right now and say that if the market continues up this week or in the coming weeks, goes to new highs, I expect this very much to outperform the NASDAQ 100. And so I just wanted to reiterate that trade still in play right there. All right, what's next? One that did hit the stop, but I'm looking at its partner in crime is PAYX. So threw PAYX out to you, and I gave you a max stop. I'll have to update this trade of 100.70. $100.70, and that one was taken out. We're still below there, so that's considered stopped out. I was only looking for 2 targets on that one, and we must have taken it back here. Still has a divergent low, but ADP, and again, this is another one that I expect to outperform, especially if the market doesn't melt down. ADP, I'm going to scroll for you here real quick. That's a busy board. Maybe I have a cleaner board here. Yeah, I do. Okay, so there is I had it drawn on the other board. I'm going to redraw it here, replicate it. There's a trend line right here, and that trend line has several reactions. Right there, there, and we're there now. We also have price support at about 224.50-ish right here. You can take it across, see a lot of reactions from above and below, as I'm highlighting here. And you have potential positive divergence. I call it potential. It's not confirmed because that PPO, I want to see it curl up and I want to see it put in an equal or higher low right there. And to do so, it'll be finalized once the PPO crosses up. And so right now there is that potential. You know, it's what everyone else would call positive divergence. Prices are making a lower low, indicators are making higher lows. Again, it's nice to see that what I call confirmation via bullish PPO crossover that effectively puts in a higher or equal trough. You can have equal lows on your indicators. If you have lower lows in price, that's still positive divergence. All right, and it's at support. And again, if the market's going to go up, or hold up for a while, this one is likely to bounce back to this level. I'd probably put the line here. I'm going to do it for you right now. I may get it out as an official trade, but again, if I'm not going to be around later today, tomorrow, that's why I want to share these with you. So about 240.32-ish would be your first price target. That's going to give you if it bounces. And I'm looking for just a counter turn rally. I'm not looking for new highs in this thing anytime soon. Now, if the charts start to firm up, maybe. That's about a 7% pop. And then your second target or resistance level is going to be this downtrend line. Let me move this up a little bit. And then about 247. So maximum right now, just to kick it back to the trend line, depending if and when it gets there, should be about a 10, 11% pop. And again, that's a counter trend bounce. If it takes out the trend line, then you have the 200-day moving averages that would come in as your next potential target or resistance level. I'm going to move this line down, borrow that, make it more of a zone. So that's it. So you can see kind of target 1, target 2. There's a resistance there. Maximum would be a bounce back to the 200s. To quantify it for you so you can calculate your stops. Of course, you could do this yourself as well. That would be about almost a 19-20% pop, and therefore you can give yourself a healthy stop of 7, 5, 6, 7%, something like that. All right, next up, let's get into crypto. All right, we'll look at IBIT. Let me start with the actual crypto itself. Okay, and I'll get to strategy in just a second. So this is BTC. Bitcoin crypto trades on the Paxos exchange. You can see that right up top there. 5-year chart with daily candlesticks and watch, rinse, repeat kind of stuff, right? We had a divergent high right here, followed by a bear, trend line break and a sell signal there. Bear market in crypto, or Bitcoin in particular here. Positive divergence, aka divergent low, bullish, what I like to see. Breakout right there that set this new bull trend up. We had the minor trend line break slash bearish rising wedge that we thought came with a divergent high. Sell signal 1, sell signal 2. Hit that 81,203-ish support right there. Target, bounce back. Back tested the trend line a couple times in this trading range and broke down. And then recently took out that 73,500, which surprised me. That was pretty good support. I was expecting to bounce there. However, we're back to it. But here's the thing, guys. We're back below it. We overshot it. If we recover it, that would be bullish, and that would most likely send us back up to these at least that minimum 81.2 level. and maybe all the way back to that 97.8, or who knows, maybe another back test of the trend line. But as I like to say, support once broken becomes resistance. So now this 73,500 is resistance, and we're if you look closely, we're not far from it, right? So it's basically an overshoot of support and a near back test. So, and this will affect all those crypto proxies again. It's a very simple trade. If you're expecting Bitcoin to bounce and go up, then you would expect strategy to go up in a multiple thereof, because strategy is a leveraged play. It's a Bitcoin treasury company. They hold Bitcoin and they use a leveraged model to accumulate it and buy it. So it's kind of like trading GDX or gold, right? GDX is just going to go up a multiple thereof on gold. So that's it, guys. I just wanted to point that out. We pretty much came back to that level today. So it kind of leans me towards, and the takeaway is, you don't give that strategy trade too much room. We had a huge, massive one-day pop on Friday. But if we can't get back below here, and it wouldn't surprise me, this would be where Bitcoin's going to go before all is said and done. If we can recover the level, we go up a little more. I'm not going to be around next day or two, so I just wanted to give you those levels to watch. If you don't have that chart, if you can't queue it up, you have IBIT, the most liquid of all the new Bitcoin spot ETFs. When I say new, the ones that came back on the market in early 2024. So, and that's it. So it's also still, remember, we had sell signals back here, sell signal one, bigger sell signal on the break of the primary trend line. And this was my preferred downside target. I've been doing frequent updates. We even gamed a little counter trend bounce here along the way, but persistently and consistently maintained this downside target, which we overshot last week, and we're still below it. So that's comparable to the level right there that I just gave you on the Bitcoin spot Bitcoin. It's funny, I forget, I wasn't going to cover it, but I made mention in some of the comments, and I believe in the videos, that ZSL, we got the juice on ZSL with the big crash on silver. And remember, this is when you don't want to be in these, because I expect the metals to grind around. In fact, silver is bullish now. I'm long silver at the moment. And so this thing's going to grind around and start to decay with this up, down, up, down. Like I said, we outperformed. We did better than twice the amount. So we were paid for taking that risk with the leverage trade when silver crashed. We hit our second target. I gave you a re-entry zone. And we still, I think over time, silver's going lower. It's just I might have to adjust these targets depending on how long silver grinds around before the next drop. However, let me show you the short-term, the 60-minute charts, and why silver's going up. You know me, I love me some divergent lows, I like to say. This is a 60-minute chart, just like I love divergent highs to get ready to short. Look for sell signals, trend line break back test. That was a crash in silver. And right here, this marginal new recent low over that, there's the initial crash low. Put in nice positive divergence. I also have those positive divergences on silver. Right here, SI. Big, strong positive divergence, just like you had big negative divergence at that high. Sell signal one, the crash came, and then we undercut the crash low and recovered it too, which was significant. And then you took out, you can see here, let me turn off all my lines. You can see the lines on my silver chart. You have a downtrend line right there, that formed that little wedge pattern. But you are coming up to resistance right now. In fact, I'm just gonna tighten up stops pretty close, see if it can punch on up to these next couple of levels. Wouldn't surprise me to see it go in and make one more, extend these divergent lows. It's been and will probably continue for a little while, as I've been saying, to digest that big drop. Going to be a trading vehicle, in out, in out, in out, long short. But that's what that looks like. And of course, it's going to follow gold. There's GC, gold futures, right here. This is that primary uptrend line. We had a brief pop, in the crash day, overshoot, snap right back above there and held that 4,600 support. It was a reaction high there. We broke above it. We back tested it for a while there, and so that's it. It's kind of post crash volatility. It's normal. All right, let's just look at gold, GLD. Okay, and there's, this is that 60-minute chart on silver I gave you when I was here. After the crash, I give you a bounce target zone, and that's still, we already hit the bottom of it once, pulled back, and that's it. That's where a level I don't expect silver. I think this was probably a major top, most likely in silver and gold on the recent highs. And the $1,000,000 question, is that it? Or are we going to make another thrust up in there? And again, the very near term is a little obscure, or not as so clear to me. Bounce target range I gave you on gold to parabolic blow off top, crash. We hit the midpoint. We're back to the midpoint. I also used Fibonacci retracements. This right here, this line you can see here. There's the 100% to the 0. So this measures the high down to the low. You can see if you carry across that yellow line. And I told you the day of the crash, that, and right before it, I believe even, that a typical, I've studied the previous charts. You can just look at the history. You can go back. That, these are the typical fib retracements, 38.2, 50, and 61.8. And I said a 50 is a normal retracement. We're right now on GLD, at least, at a perfect 50% Fibonacci retracement. So some traders will trade off those. You also have the PPO signal line, that white line, back testing the 0 line from above. Typically, when it's above, the trend's bullish. When it's below, the trend's bearish. So again, silver and gold are at resistance levels now, but I don't have super strong convictions. And again, GDX is just going to follow them both. I gave you this 60-minute chart. That was the first support level was taken out. I give you a total of 4 targets. T1 was hit, T2 was hit, T3 was hit, and we bounced. T3 was hit again, and we bounced. And just like silver and gold, not by mere coincidence, GDX on that second low, although it didn't make a lower low, it made an equal low. That's still positive divergence. You have equal low in price and then higher lows on the indicators. And that's this catalyst. So you've got this little trading range right here. And, if silver and gold can punch up through resistance, then you're going to probably go up higher. And there's your next resistance on GDX is a gap backfill right here. That's this big gap. There's the bottom of the gap. There's your gap. It's also reaction highs. That's 105.46. So that's a potential bounce target. And I'll bet you if I put up fibs, which I'll do now for kicks and giggles, that'll probably align with about the 61.8. Yep, there it is perfectly. Right there. I snap my fibs to the recent low. And I've done this long enough I can just look, and I'll tell you, it never fails to amaze me. I always do my price resistance and support levels first. Then when I throw up the fibs, how well they will align. Like I said, if you can see it, that's the 61.8 comes exactly where I put that level there at 105.46, right at the gap. So that's a logical target, close longs on a GDX, turn around short, at least for a pullback trade, if not quite possibly the end of the counter trend bounce with a move down to come down to T4 there. Okay, and as far as trades closed out, we've had so many trades in this year so far. And in the past on the site when volatility's high on any security, or big moves on just regular swing trades. We had that natural gas trade, and I keep throwing out these short-term trades. I remain longer-term bullish, but then short-term, we're just going to shear the meat off the bone of these little rips and dips. And so that one we took right there. And as I told you on what was that, Friday, was it? The 6th, whenever that was. I had additional targets, but I canceled them out and said, look, pre-market we hit, because the futures had just hit. I'll show you that in a second. Right there at T2 zone. And another one of just many beautiful exits lately on UNG when you look at that. Again, I had the pre-market trades are turned on in white. We hit it to the button. I think it was the top of the zone. And we turned around and we were able to sidestep a give back of 15%. And I'll tell you, it's getting close to a point of a recycle back in. And that's why I'm updating it here. You see a positive divergence on this low here. Let me show you the chart of the futures real quick. There's the N, where is it? NG, this was our, at the same time I gave you the UNG trade, I was looking to go long NG here on that 330-ish support right there. Had a little more downside to come, and then boom, 364, or we'll call it 364 and 392 were your targets. And then we did, let's see, where is it at now? That's not it. That's not it. I've got it here somewhere. There it is. All right, so right there was our entry, and it went a hair lower. I've since added this support level here, which we're at, which by the way, just like on the futures too, you now have positive divergence, marginal new low. So you can make a case to step back in this one if you sidestep that 15+% give back. And again, on that initial chart I had for you, the first target was 364.3, and that coincided with the hit. That was the same morning right there we exited on UNG. And again, kind of a instinctual exit where I canceled out the next targets, and that's that big drop back. So nice exit there. I mean, we've done it with a lot of stocks, MOH, we did it with the healthcare plans, a couple of these stocks. Divergent low, we entered there, hit my first, second, third target, which was 200 days, came in as well. And just a beautiful exit, hard exit there, drop of about 40%. So that's swing trading. Sure, just get in, get parts, as much of these rips and dips as you can. And guess what, guys? Just like, and this is why I'm highlighting it. This one, we were able to hit our final target with near perfection, get out, and now we have an even bigger divergent low. So I'm going to borrow you, put you there. And again, I'm going to hold off on this one. I would rather see it come down here to this on the weekly chart, which I just toggled to that 106.85, closer to it. So a little around 107 if it gets there. That would be a better entry point, because again, divergence is not a buy signal, it's a condition. And if we get there, we're still going to have this divergence will be a little larger on the weekly chart. And so, you know what, I'm going to set an alert right now. I'll do it this way. Well, I'll just set a price alert. Click here, create a price alert, create it for 107, just so I have a heads up. This is what I do in case I forget about it. 107.30, right? And it'll tell me when it gets there, and then I'll take a look at the chart and get ready to buy and get it out to you guys. So so maybe we can recycle back in, because again, we have a divergent low, but we don't have it's not at support. And there's that really nice support on the weekly I'd like to see us hit. And I was going to wrap the video up there. I just heard, you might have heard an alert just go off. That was TOST. We just closed this one out. Again, here's another one we entered. I guess we shorted it there, I'm assuming, because I had a stop up there. Went down. We hit my first target. Bounce as expected. We hit my second target. Went down a little bit. A little bounce back to the... And that also took out the 200s. Bounced back to the 200s, and we hit my third target. We bounced back to the 200s again, and we hit my fourth and final target. So there's one where we sheared again. Nearly all the meat off that bone. Am I ready to reverse it? Not yet, but it is in software, and you guys know my thoughts there. So let's again, I'll be back in my chair Thursday morning. I mean, technically Tuesday night. So I'll continue to update these, and let me know too, guys, if you prefer. Most, I think, like the convenience of ETFs, the diversification, meaning you buy one ETF like XSW, you're in all the software stocks, including Microsoft, the big ones, the little ones, and you don't have to worry about earnings. When you hold individual positions, you have to be aware, when are they going to report? Because if you get caught on the wrong side of a big earnings gap, you're going to feel pain. Whereas, yeah, a stock can gap up or down and affect the ETF, but it's safety in numbers, that diversification. But the flip side is, if you're interested in any sector, whether it's GDX or gold mining stocks, whether it's biotechs, I can go through and pick out, when I'm bullish on the sector, pick out the most bullish stocks, and 99, if not 100 times out of 100, outperform the sector, because it's just like trading the indexes. When you buy the NASDAQ 100, you're buying in one fell swoop. When you buy QQQ, you're buying 100 those 100 stocks, but you're buying some stocks with very bullish charts and bullish price action, and they're going to go up. And you're also then buying the losers of the NASDAQ 100, and they're going to drag down. Now, it's a cap weighted index. You're really just buying the Mag 8, right? Just go with that for now, pretty much. But you could say the same with the S&P 500 or something like the Russell 2000. So let me know your preference. I'm curious to know if most of you prefer when I'm bullish on a sector, the ETF as a trade idea, or would you prefer individual stocks? I usually say I like to take a shotgun approach when I'm bullish or bearish a sector instead of picking my favorite stock in that sector and just going long or short that one. I'll usually spread out a half dozen or so of my top picks because it's just going to be, my or your dumb luck if you pick just one, that's the one that's not going to play out or it's going to go the other way, right? It's not proper money management. It's risk taking. So I like to spread my bets. All right, I will wrap it up here. Let me get the video out to you guys. This has been Randy Finney with Right Side of the Chart. If I get any questions today before I leave, I'll do my best to answer those, any chart requests. Otherwise, I will pick things back up on Wednesday morning. Have a great day.